The Fed's key inflation measure is showing prices are climbing at the lowest level in nearly 2 years. Consumer spending is strong, and this week's GDP report revealed the economy grew more than expected at 2.4%. Chris Toomey of Morgan Stanley, whose team is number 5 on Barron's list of the best advisors in the country, is joining me now. Chris, thanks for coming to the studio.
Thanks for having me.
So, the Fed took very dramatic measures to rein in inflation, seems to be having some success, and yet it didn't kill the economy in the process.
Sure.
Wall Street seems to be happy about this. What's not to love?
Well, I think those are famous last words, right, Jack? Like, what me worry? Look, I think in fairness, Chairman Powell's getting a lot of credit for the hard work that he's done. The market is responding in a very positive way. And for a job that kind of typically ranks with regards to a similar category as weatherman, this is the first time he's starting to get some of that credit that he hasn't been getting in the past. I think in many regards, we were very defensively positioned in 2022. 2023,
which was a good call.
2023, we were expecting earnings to go down, GDP to moderate, not necessarily go into an inflation or go into a recession, inflation to come down, and that with those earnings going down, we would see muted prices with regards to the stock market. I think what we got wrong was first the fiscal stimulus. So the Biden administration passed 2 big bills or big laws, the CHIPS Act as well as the Inflation Reduction Act, which we see a fair amount of stimulus within the economy. And then we had that banking crisis, which added that monetary stimulus with regards to liquidity flowing in the system. But if you look at the projection with regards to the path of the stock market, whether it's the S&P 500 or the NASDAQ, up 20%, up several 30% or so, what you're seeing is the fact that we've just gotten PE multiple. Earnings are still down about 4%. If you look at the earnings picture, we saw earnings go down in the fourth quarter. We saw earnings go down in the first quarter, which confirmed an earnings recession. And second quarter, we're expecting earnings to be down about 9% halfway through that. So we are seeing continued earnings, and that's a concern to us.
But could the market just be looking through this, saying, okay, no recession or muted recession, inflation will be whooped? Of course, PEs are elevated because earnings are down, but earnings will come back and we're all set.
Yeah, I think that is a misperception with regards to the market. Obviously, the trend is higher, perception is higher. In reality, at the beginning of the year, I think the concern was that the Fed was going to do too much damage, that they had raised rates too quickly, too fast, too aggressively, and that the economy was going to be experiencing some trauma in the first half. And that if you remember, the bond market was pricing 2 rate cuts in the second half. Now we're in a situation where not only did we not get 2 rate cuts, we actually saw rates go higher. So what we've seen right now is really a disconnect with regards to the market and rates, which would have typically driven that PE multiple higher. So in our view, the PE multiple's too high and earnings expectations are also too high, which is typically a recipe for disaster.
I want to ask you about one thing that does worry me a little bit, and that is that a lot of companies, unprofitable companies, are still paying off very, very low rates on borrowing. It was free. When those turn over, they are going to be paying twice, triple what they were borrowing, and some of them just don't have the cash flow to cover that. So this lag that you hear about with the Fed rate hikes, we could be seeing that over the coming months and years. What do you think?
I totally agree with you. I mean, Milton Friedman famously said Fed policy operates with long and variable lags. This is the lag that we're seeing. And a lot of that has to do with sensitivity to interest rates by the consumer and businesses, right? So the consumer during COVID built up a huge savings in their balance sheet. We saw them refinance.
No vacations.
No vacations. They saw them refinance their mortgages at very low rates. A lot of those are 30-year mortgages. So they're in pretty good shape with regards to taking advantage of those low rates. You also have a situation with regards to corporates doing the same thing with regards to pushing maturities out and also refinancing at lower rates. The problem is that if you look through that, in the next 3 years, we're going to see over $5 trillion that needs to be refinanced. And a lot of that refinancing is going to be at rates, like you said, that are twice what they were originally financed at. in a situation where those businesses are going down, right? So in an environment where the cost of capital is essentially zero, a lot of businesses will actually be able to do very well. In this situation, you've got about $500 billion worth of distressed debt. Only 10% of that has defaulted. So that is a big worry with regards to what's going on in the market.